Hello everyone, welcome to Kullastandard podcast number 20. As you can already tell, this is our first podcast in English. My name is Mait. I'm an analyst for Tavax Group, the biggest precious metals dealer in Northern Europe. And our special guest today is trader, technical analyst and teacher Francis Hunt from the marketsniper.com. Hello, Francis, and big thanks for joining us today.
Absolute pleasure. Delighted to be with you.
Okay, before we go to the big picture economy and the markets, let's talk about your life work. So I have been following for you for 3-4 years. You have made some huge calls. For example, predicting sub $10 oil price. As we know, it went to zero in 2020. You predicted in, I think, August 2020 that US bond market, 40-year bull market in US bond market has turned. You predicted gold price rising in 2019 to 2020. And also you already, I think last year in November, you predicted this bull move that we are seeing right now on the gold markets. So you developed something that you call a Hunt volatility method to make these predictions. So you combine it with fundamental analysis to trade markets. And can you give us a brief introduction of the HVF method and your trading philosophy?
Yes, certainly, mate. I'm delighted to do it. So there's two things everyone should do. You should make the slow money, which is investment, and you can sweeten that if you earn the right to a small amount of leverage with skill sets and real methodology. In an absence of methodology, for sweetening your performance, you will default to emotional responses. And emotional responses are very simply captured are greed keeps you in the trade and only pain takes you out. So the inevitable consequence is you exit on pain, which is a suboptimal exit, and you stay greedy whilst things are going your way. So people are inherently momentum chasers. This is why we have phrases like FOMO, fear of missing out, etc. And this is the fight and flight responses rather than trading rationality. So the Hunt volatility funnel is actually a process you superimpose upon yourself to take yourself away from these negative attributes of emotional responses into doing something that is process derived. And the Hunt is me, but the volatility funnel is the unique moment where you get compression in price behavior. So most people say we must trade with stops, but actually those stops end up doing way more damage to their trading performance because they're not the right place. The average range is too high, so it's inevitable that at some point the range will come back down and take them out, and they end up being a scalper of losses because they are entering trades at inappropriate times. So when you get that compression, which we had on the gold market in February after breaking the 2000. You mentioned in November, we said the next time it goes, it's going to go for real. And we had a winding up and we had a very low volatility period. And we'll show you that chart in due course. You had an opportunity where you could have a rare chance of having a tight stop without it being run if the direction of break quickly took you away from your entry into a fast-moving breakout in the opposite direction. And that is the attraction of an asymmetric. So asymmetry means much higher potential gains than what you stand to lose. So asymmetric rewards to very tightly managed, risk-managed stops are what we're interested in. And trending markets often will have these pause periods, usually with 3 impulses, where the market calms very, very low and it's seeking a new driver. And the market reaches this point of mutual disagreement, I like to call it, where this is kind of the level. It's kind of the station where the train sleeps tonight, and that's the price level. And then new drivers come in, and usually this is in the same original direction. So this is continuation. Most people want to call tops and bottoms, and we say the real meat, the burger's in the middle, the patty's in the middle. You don't want to be nibbling the bread at the top and the bottom. The first 5% I'll let other people prove. What we want is the juicy early. We want to be early, but we're never going to be the first 5%. These are the big movers. This is, for example, in gold, the central bankers starting to become concerned about US debt and starting to reallocate away their treasury department more into gold, and you start to see that stirring. So we are continuation traders rather than inherently reversal traders. That said, because we study continuation so much, we also see things that concern us about the ability to continue. So we've learned a lot about reversals as events as well. That is the HVF method. Asymmetric reward, and it's a discipline where you now submit to process. So instead of swinging like a drunk in a pub brawling wild right hooks, you've gone to the dojo, you understand how to do a throw, you understand how to do a punch properly. And the market sniper analogy, just as a final point, because I don't want to overrun on this explanation, I'm sure you've got more you want to talk about, but in the global conflict, I'm not a gun freak, I'm certainly anti-war generally, but the efficiency of sniping versus the average infantry soldier was shown in World War II. Essentially, 250,000 rounds were fired in World War II for every one that served its purpose, which is actually terminating an enemy. And in Vietnam, that actually went up to 450,000 rounds. So it's the biggest, most wasteful thing. And I actually want to highlight that aspect of war. It's an incredibly wasteful thing. Lead is being thrown around in trees. That's what's basically happening in a jungle battle. However, when you had the unique special force, and typically snipers were special forces, they were smarter, they were more comfortable with being alone. I'm kind of that lone wolf myself. I have friends, but I don't feel I have to sit in big groups all the time. The snipers were very useful for reconnaissance. Their numbers have been consistent overall of military conflict. And typically they have had a casualty for every 1.3 rounds fired. Now, if you compare the efficiency of 1.3 to 450,000, you can understand why two snipers can hold up entire brigades of infantrymen. Now, I'm offering people, rather than getting excited about war, to be snipers of the markets rather than the man running around with the Uzi spraying lead in the jungle. That is a headshot for you coming in terms of your trading success. Whilst for snipers, they move in, they take their position, they're unseen. And the reason they have such great conversion rates in terms of that 1.3 is they shoot very rarely. In other words, they wait absolutely for the ideal conditions where it's a near certainty that they get the outcome. So the wind, the distance, and they often change, they can change the course of a war. On account of shooting a general or a high-ranking officer where people have thought there's been no one there and it's a safe place because they are avoiding shooting everyday infantrymen. It's a high-value target, it's a high certainty, it's a high probability, it's a massive reward, and they already know their exit levels, which is part of the trading analogy as well. And they get out quickly after they've taken a big scalp. And those are the approaches people should take to market. Not every day is a reason to trade. Sometimes the best trade is no trade. In fact, that's the common cause.
Thank you for this introduction. Now I surely know why it is called themarketsniper.com. So before we talk about the graphs and gold market and overall markets, let's watch the fundamental picture. You are talking a lot about this debt collapse and the monetary reset. Can you talk what is the basic mechanisms of our current monetary system, and why is it coming to an end through debt collapse, and why is it important to know for a regular citizen here in Europe or here in Estonia?
It's very important, and it affects everybody. And it talks about a market that most people don't understand, which is why it becomes boring. It's not taught at school. It's almost mercurial. Everybody understands equity. You understand Coca-Cola. You see the product. You buy their sugar water. You know what it tastes like. But the debt markets are a bit confusing to people. But money is borrowed into existence. When a European buys a property, he's not taking somebody else's savings. That's not a fixed amount of money in the environment. Banks have a license to create money. In essence, that is granted to them by the central bank. So they're actually creating new money, and they're putting them in a computer, and they're saying, you owe us 500,000 euros, and you've now bought the 600,000 euros house, and you put down 100,000. And that is in a creation of a debt instrument, and it has an asset and a liability. So this brings you into T-bill type accounting. Your asset is the house, but the bank represents your liability for the amounts I've just mentioned. And to the bank, it's the other way around. That loan is their asset against you. And as a result, they have a vested interest in the security, which is the property, which they'll continue to have a control and be first creditor on. So that's expanded the monetary supply. So what's actually happened is we've gone through a financialization of everything. Not so much in Eastern Europe, where you may be, and Europe generally, but very badly, and certainly in London, the central hubs, Northern America, the Commonwealth. I would say globally, really, in truth, but in some places more so in other. We've financialized everything. So in America, people don't even know what they're paying for a car. They'll probably be buying a $95,000 truck that's going to end up costing them $137,000. They're going to finance it over 72 months. And they're going to be buying 50% of the vehicle. So what ends up happening is they trade the vehicle in, and if it's below 50% in value, they roll that shortfall into another shotgun finance deal that they end up doing. And note, I use shotgun instead of sniper gun in this instance because it is exactly that. And they continue to have massive loans that continue to expand, that they on purchases they never complete. And are captured financially and put on the wrong side of a financial compound interest equation. Too much of this has gone on, not just in vehicles, in housing, etc., etc. So the credit system is gone. And when I say I mentioned consumers here, it's the same for municipal areas, state, nation, national level, right the way through. Corporations, their corporations, when the interest rates were so low, they say, well, the cost of loaning is lower than the cost of issuing equity. So they borrowed money from banks to even pay dividends. At one point, I think there was about 15% of S&P 500 companies couldn't make their dividend payments and were using cheap debt to make dividends, to make their share look attractive. This is unsustainable. It's mathematically impossible. And there's nothing Trump or anybody new that he brings on can do it. Not Elon, not anybody else. So there's going to be a lot of word sandwich and word salad going on about we are going to make the government more efficient, and we're going to cut this expending, and we can turn this. It's an oil tanker. It doesn't turn around in a day. It's gone way too far. And I actually think it's part of an agenda to have this collapse. So that's why we called the turn. Technically, we saw it technically in the charts, and we've seen the likes of Stanley Druckenmiller now come to our side of the ship. Paul Tudor Jones, Zero Hedge have started to release articles. This is some 3 to 4 years after we stated it, and we shorted the TLT at the time that it happened, all the way down. So we don't just make calls. We're not an analysis company. We're interested in trading and building wealth. So the debt market has turned, and this has major repercussions. I'll let you unpack that before I take us into gold, but that has major repercussions for the financial system.
Yeah, thank you. Why do you think, like, many people have talked about like US going to bankrupt, or US like this debt collapse for like 10 to 15 years? Can you maybe talk why it hasn't happened yet, and why is it started to happen right now? And maybe bring up some bond market charts to explain it.
Sure. So just because somebody states something factually accurate doesn't mean they're good timers of the market. The trajectory of the US has been a steady step towards bankruptcy, but the ability to print and pretend and continue is ongoing. So what determines when the moment will be? So we're now becoming, it's not about the fundamental fact. I think it's a fait accompli. Mathematically, it's too far gone. And even if you literally stopped most discretionary expenditure, it still wouldn't help you. But why now? And why are we talking about this is the quickening phase and it's going into acceleration? Well, the bond market showed it, and it's worth possibly bringing in that particular call that we made on the bond market. So I'm just going to get the appropriate chart up in the meantime and show you this. This is a 10-year yield. Let's get that up and start sharing. That's the one I want in truth. And I'm just going to take some of my lines off. This is the US 10-year. So what happens?
So this is like if US government wants to borrow for 10 years, this is the like interest rate for this.
Correct. This is what they have to pay in yield to get the privilege of being lent money by the market. And that creates an asset for the people that are the lenders. They receive the income stream of the percentage of interest rate, and then they receive the full capital amount at the end of the 10-year back. So you would borrow 100,000 today, only in governments it's typically 100 billion, or sub numbers of that nature, 10, 50 billion. And that's what gets returned in 10 years, and you receive an income stream in the meantime, which has meant these assets have been popular as pension assets for people that are aging. Typically, they've been way more stable, way more boring in how much they grow in value relative to the equity market, which is why you have the 40-60 portfolio of bonds adding stability, which basically means they don't tend to go down very far or hard, typically. I'm going to come back to that point in a second. Whilst equities, when equities are having a great time, bonds typically languish a little bit, but they're paying you a small amount of interest. And then when you have crashes in the equity markets, people get out of bond markets and they buy the bond market as a defense, so they can get a yield and they find the equity market too risky. So this was a kind of binary framing. People have forgotten that actually before the 60-40, there was always an element of gold in the portfolio. But after the events of Volcker, gold got virtually, with the financialization of everything, got eliminated. People used to hold 10%, some even 20% of gold as insurance against inflation, which is proliferation of fiat currency. But anyway, the Vietnam War, going back to the Vietnam and the war side, more munitions were dropped by the presidents Johnson and Nixon during the course of the Vietnam War than by America than anything they did in Europe during World War II. Most people don't realize this. And the military-industrial complex was making out like bandits, and the government was borrowing. They did carpet bombing of jungles. People never saw it because it wasn't close to home. It wasn't largely reported. It was criminal, actually. They did, chemical weapons in Agent Orange, the first to do chemical weapons. They also did flame napalm, which is basically roasting people alive. I mean, it was pretty damn criminal, and they built up a lot of debt for these experiments in exterminating other people in another part of the world. Anyway, that moralistic statement aside, they built up a massive amount of debt. And that's when France started to call for the gold rather than the money. They were cheating. They were creating too much money, and they no longer had it fully backed. So they suddenly had a run on the gold. This is fraud, actually. It's kind of like me saying, my currency's fixed to gold, but then I'm creating more of the currency and I'm not buying in the gold. And then people call it out and they'll say, here's your paper back, give me the gold. So there was a run, and that's why they closed the gold window in 1971 under Nixon, who said it would be temporary. Whenever you hear temporary from a government, no, it's forever. And that was what's happened. But anyway, Volcker rang out that debt during that period by raising interest rates to what was a typical high. It shows us around 16% on the 10-year. What he was doing, when you increase debt, there is the seesaw effect. The value of the debt is going down, and the yield is having to go higher to attract buyers. So only the people that bought at the top the bond market at the top, when it was paying 16% yield, bought it cheaply because the debt was very low value and the implied yield was very high. Then they had a 40-year bull market, essentially from 1980 all the way down. And I highlight the events of March 2020, CV19, as being the final capitulation in yields. You had a blow-off top in market valuations. So the value of bonds is the exact opposite chart. Remember, it's an inverse scale. So if I just invert it, there was a blow-off. People understand. .com blew off. That's what happens. Final blow off. A real reason why you didn't want to own anything risky. You bought bonds and off they went. They went super high value and you had a capitulation in the yield. You went as low as 0.3 and yet all this money was being created, which is super inflationary and proliferated. So we had a turn in the debt market. That was the key call, and we confirmed it. I mean, there was lots of nice upside continuation on the yield, which was actually downside valuation on the likes of TLT, which is an ETF of long-term debt, which I can get up as well. But anyway, the question you ask is, why now? Because the trend changed. They got away with issuing money, and the assets kept climbing in value, and they were issuing ever more of it, because they were managing down the interest rate. How could they do that? Well, first of all, they washed out a lot of debt in the 80s and they devalued it immensely. So they fixed their balance sheets by that terrible stagflation. It was like a detox of a heroin addict. The 70s were awful for America, but that's how you fix your balance sheet. You take the pain of your binge. And you fix yourself. You know, you go to the detox farm and you stop taking the drugs and you eat healthy things and you get fixed again. And now you feel good again. You think, let's go party again. And essentially we did that. And that 40-year is over. And we're now at a period where there's much less room than before to move. So we have much higher debt, much higher rates. America is paying the highest interest on debt, more than Japan, more than everyone else, because they've got a combination of high debt and high rates. But don't forget the Japanese rates are, while slightly more debt, is higher, is lower. The Japanese rates are a lot lower than the US rates. So they are paying the most on interest on debt at the moment. And it's our opinion that you've had 3 cuts, a double cut and then a single cut. And during that period, actually the 10-year's gone up. And it's gone up so much that I think it's a problem. And we're going to have a pullback, I think, on this yields. And I'll show you technically what we've drawn on the shorter term. So what I was showing you was big macro charts, the 40-year period. We're now dropping down into a lower time frame. And this is what we call a 3-impulse falling wedge. And it is a continuation pattern. Remember, we love continuation. But it is, I suspect it will probably have one more finishing dip down. So we could have a bit of a disinflationary event, a bank crisis, a repo market crisis, maybe something else that brings the stock markets and all the risk on liquidity stuff that's running right now a little bit off. But the longer run, after we've had a dip, is we break this red line to the upside. So we will see new highs in rates in the future, despite the fact that the consumer is in deep trouble. Jobs are being reduced. The labor numbers have been shown to be a farce in America, and that actually points to a wrecked consumer and wrecked retail markets. So the big areas that are benefiting are AI, the military industrial complex, Google, and all the associated mega tech corps that are benefiting that. So you almost have this twisted balloon economy where one half is all the air and the other is flat. And that's your consumer and man in the street, your everyday consumer. Obviously not somebody working for Amazon, Google, or Nvidia, but the everyday man is suffering quite a bit. So let's let you unpack that for a bit before I continue.
So basically, the reason why it didn't happen, like, I don't know, 10 years ago or 15 years ago, the reason is that they managed to lower the interest rates and debt servicing costs stayed like down. So now
civilization played a role in that. I didn't mention that. And they used all the advantages. They outsourced all the workshops to the lowest common denominator of cost. So you had Philippines sewing up Nike football boots and things like that, with often child labor and various other things, quite low moralistic, but getting away with very low costs. We've exploited all of that. And in actual fact, some of that's reversing now following the bifurcation with the Americans taking the Russian bond money. So that allowed an artificial once-off benefit that reduced cost of living for a lot of people. You could buy, change clothes, they were relatively cheap. So these things stayed cheap for a while because the cost kept going down. So you got a once-off benefit, and we kept the interest rates too low. And we got asset bull markets. You got the dot-com, you had the property booms. That's still inflation, but the inflation, all this liquidity now washes into assets. So you have hyper-valued assets everywhere in the US, particularly the housing market and everything. It's an important point that benefit, instead of being stoic and keeping rates conservatively high, we said, hey, there is no inflation. Meanwhile, there was. It's just because of everyday consumables getting super cheap, we dropped the interest rates too low. And of course, everyone said, with such low interest rates, why not borrow? It's cheap. Buy this, have what you ever want. So we partied hard and we put it on the credit card.
Okay, so now the rates are like going up, and could we see something similar that happened in Britain, or in Britain in 2022, I think it was September, like where the rates go up really fast in a big economy like US?
Yes. So what continues to happen is that the issuance of debt is getting ever faster. So it was 1 trillion every 100 days. After August, the rate that they finished, it's actually 1 trillion every 81.5. And in fact, they have a book year end on the end of September, and there was a massive step up in US debt into October because that falls onto the new president's books. So the Democrats who are in power actually stored up and spent a bunch just pre the election to create some feel-good factor for the election. It didn't seem to have worked, but you had a spike. So actually the real rate, when you aggregate it, is super, super high, and they're issuing a new trillion. Now, anything that's issued in such scale cannot be valuable. So one of the things of value is scarcity. And there's no scarcity of debt. So it's coming at an ever escalating rate, and it's in a parabola. So unfortunately, we're on the steep end of the curve. So your question is, can we get an event like what happened in the UK with the pensions crisis? I would almost refer you to a different UK event, and that was the event of George Soros breaking the pound. It was a microcosm test of one country, but that can come similarly for the US in a kind of way. Because the US is the primary currency, it will have a certain different tinge to it. But what ended up happening is people thought, the central bank heads set interest rates. Actually, they don't get that privilege when they are in deep, deep trouble. The markets take over and set them. And that's why that 10-year has gone up on 3 cuts already. It's people saying, I'm not buying. I'm not buying at that price, and I'm not getting such a low yield. I'm buying cheaper for a higher yield. Otherwise, I'm not putting my money in. So it doesn't matter what you do at the end of the day, I ain't having it. So what ends up happening is the price discovery mechanism starts to force the hand. And the UK actually changed interest rates twice in the same day. People forget, there'll be many people that are a bit younger than me, I'm sure, and they might not know this. And that wasn't because they had a cup of tea, a cucumber sandwich, and decided, we got it wrong this morning, let's have another go. That's because the financial markets were dumping the pound and dumping their debt so hard, they had to make it really more attractive and harder for the people that were shorting. So they upped the rates even further. And of course, eventually they got the run to stop, but at great damage to the currency and the debt instruments. And that all started because Thatcher came in a bit too high with the pound valuation to the Deutschmark, and the likes of Druckenmiller and Soros spotted this, and they went in big. And then everyone smelled blood, and it was a stampede. So the question, could it happen to America. My argument is it's already in process happening to America, and America will typically lead the interest rate rises. But many people will say, oh, but the America is the best the economy because the dollar's going up. It's a sick and dangerous appreciation in the dollar. And that's the difference with the UK scenario. Because they're forced to put rates up, they, being the currency of the world, they will actually have a currency spike. But it won't stay high valued, but it will spike as they devalue the debt, which is the interest rates going up, devaluing a huge amount of debt. But there will be a debt collapse and there'll be a lack of interest in people buying that debt, but they will get a spike. The problem is a lot of nations have borrowed in offshore dollars, and that will force contagion into the emerging markets. You think of Turkey, South Africa, where I'm sitting today, many other nations that might have built up a lot of dollar-denominated debt. So we're going to have a lot of nation-state bankruptcies, in essence, brought about by that. But it doesn't mean it's going to be great for the US either. But those that are currency-focused may benefit from the spike in the dollar, but it won't be sustained. And usually this is when everything falls apart and you get proposed a Bretton Woods type moment and a new system that is being brought to the table.
Okay, yeah. About the new system, I mean, on this chart, you're showing like this interest rate for 10-year treasuries. How high does it has to go so that everyone on the bond market and markets like start rushing outside of the market because of the interest payments for US government go up just so much that it's getting really obvious that they ain't gonna pay it back. They're gonna pay it back with inflationary policies.
It's very much like when you put your hand into a sweet jar. You can take one sweet and pull it out. But if you feast and are so greedy on the way down that you try grab a fistful of sweets in the jar, the problem is you can't get your hand out. You can't come back out the neck of the jar because your hand is too full. And what's in essence has happened is you loaded up too big on the cheap and easy moments, that the sensitivity of the system now is too sensitive to rate change on that interest rate payment. So I would start to say, I don't think this goes anywhere near where it was in Volcker's era, because the interest rate payments on American debt will be outlandishly large well before that. You know, it's 7 and 8%. You know, you won't have too much room for much else in the budget. Interest rates, that is, on the 10-year, for example. And that's going to be an absolute crisis. So the whole financials, already America spends nearly twice what they get in on tax revenues. So that's a guaranteed new issuance of debt continually coming in. If we get a move well beyond 5, going to 6, 7, and 8, all hell will break loose. Whilst you'll have that paradox of a spiking dollar, you will have the bond market in absolute chaos. So the notion that the FX market is a different silo to the debt market is a failed model. These things coexist. They're like one of those sweets, those cinnamon sweets that are twisted in together. They are totally entwined. So you're going to have chaos in the FX markets, you're going to have chaos in the bond markets simultaneously, and you're going to have emerging markets and other nation states, because actually the first world, as they like to think of themselves, are as deeply, I refer to the global synchronized leper colony of debtists. They've all kissed the chief leper to become in this state. So this is a synchronized takedown. There isn't a sound money nation. Some might point to Switzerland, Singapore, etc. But if you take most of the world's nations, they're all hyper indebted. And as a response to the CV19, which you saw was a seminal event for the end of the bond bull, which means the game is up for borrowing. The borrowing into existence money ended. The game is up for it after the turn of that 40-year trend, because we loaded up too big. We can't handle the upside. It's kind of like me and you were fit athletes that could run a marathon really well. And then we just started gorging on food as it became easier. We had roller skates, then we got, then we had a car and then everything. And now all our stuff's been taken away and we have to run it again. And we're now 250-pound blubber balls. We're not finishing that marathon, we're dying of a heart attack. It's the exact same. So lots of analogies. It's over. The 40-year bull market is a seminal event that ends the fiat and debt system. And you're just waiting for those rates to get high enough that the interest on American debt or Europe to fail before Germany's doing plenty right to ensure its destruction. And it is the spinal column of the euro. Don't forget, they backstop all the southern Mediterranean nations that couldn't pay on their debt situations, and Germany was soaking up the toxic Cypriots, Greek, etc., etc. So, it doesn't matter who falls first. They're all got the same disease. They're all in the leper colony, and they've all got debt leprosy.
Yeah. The interest payments on US debt also, like this is also already parabolic rise. But can you maybe shortly give some time frame? What do you think? When do the rates go to these levels where this going to be a chaos on bond market, like 7-8%, where we're gonna probably have like two or $2.5 trillion on interest payments? That's like half of the U.S. government revenue. Can you give some time frame on this?
As I mentioned, I think the 10-year is one of the most interesting because of where it is technically. I do actually think there's going to be a scare that's going to cause a bit of fear that might take one of the problems the debt market has is there's just more attractive places to be invested, given its future and its trajectory. And many people have already recognized that, and they're already deep into tech and AI and the likes of Nvidia. But now you have hypervaluation, forward discounting, all sorts of parabolic gains that are yet to be achieved, priced for perfection, as many people say, at 58 times sales for Nvidia. You're going to probably have much the same with Tesla as it gets a little bit more autonomous and into the AI space. So you're having hypervaluation. All this liquidity has pushed the entry point so high that there's more. Remember, I was talking about asymmetry. Your stop loss, your risk of downside is far greater than potentially your gains. That's the exact opposite of what the HVF method likes to have. And that's the wrong entry trade. So that's why you're seeing gold running. And that's why you're seeing Bitcoin now take over more recently, because Trump is pro-dollar and now is talking pro-Bitcoin and doesn't mention gold. Very typical of central banker behavior. They try not talk about gold in public, but they watch it like a hawk. So they know it is the honesty stick that highlights their malfeasance and fraudulent behavior. So, they tend not to want to talk about it too much. But in terms of timing, I think we've got a couple of months possibly of a little bit of cooling, maybe in the stock market, maybe of Bitcoin, before we pull back in and then we break here. And then we're going to have an upside. I could see us going back into the deep fours and possibly meeting the 5. Whether we round out and we come back again with a bit more fear, it's a bit difficult to predict that far ahead. But in the longer run, whatever comes here, I see going higher. Whether it'll happen in this move or whether it'll cycle back, it's very difficult for me to give you with any certainty. I can throw many probabilities at you, but a falling wedge is a continuation pattern. So that means the next big impulsive move is the breaking of the red line that I've drawn. And we've been modeling for this for quite a while when this 10-year was down here. And I'm going, it's funny, they're talking about doing cuts, but I'm actually seeing the 10-year going back up here. And now it's done exactly as we predicted, but it's gone into the face of 3 interest rate cuts. And I never expected that. I thought I'm going to be proven wrong, but I do think this is going up to our red line. And I put this blue flag floating like the 2 others before it. So it shows that the market will move the rates, not the Fed, for those that doubt it.
Okay. So the larger process, if you go to the gold now, a larger process, as I understand, is the fact that basically capital is flowing outside of government bond markets, and it's flowing into gold. That's why gold is going up right now. So can you give some like short-term and maybe long-term targets for gold and some HVF setups?
Yeah, so well, the last time we had a HVF setup was on a smaller time frame. So I'm going to answer the second part first, and then I'll get to the HVF setups. So in terms of projection for targets, remember these are macro, these are not overnight. It takes a fair amount to move what is probably a 15 trillion market cap up. But I will also highlight the debt markets and the currency markets are far more vast. Throw in the derivative markets into that and the contagion of all of those things collapsing, and you're talking quadrillions. So everything is relative. But our macro targets, and you'll see, I'll just make sure everyone recognizes the chart first. This is what we've done since the 2001, 2000, 99, 2000 lows. These are very, very useful. That was peak tech everything. And from there, the gold started to perform a little better. It had been totally definancialized. Everyone on a 60-40 portfolio. There was no mention of 10 or 20% in gold. Now you almost want to be overweight in gold. In other words, it's kind of like if someone tells you they're going to burn your house down, rather than just insure it for 70% of its value, like you might do normally at replacement value, over-insure it with 3 different insurers at 125% of its value. And when it gets burnt down, buy yourself a castle. You know, this is the thinking. So I'm aggressive with gold. So bear in mind, this is not financial advice, but I will be overweight by intent because this is gold's time. There will be some challenges had with that, but the question you asked was, what are some of the big targets? On the big time frame, this bull leg run up into the 1927 high, that's $1927 of 2011, gave us quite a big projection. And when that is projected up in a log scale fashion, I'm getting the biggest and the sexiest number is we're going to pass 7,800 in gold. But that dollar will not be the same dollar you think of today. There will have been events of some scale that will have occurred with that. We also have a point where it will rest possibly in and around 6,500. So those are real big macro stretchy ones. I know it sounds crazy to some people, but I expect to actually surpass these even in due course. And a lot can suddenly happen in a few years. You know, you can have decades where nothing happens, and you can have years when decades happen. If you're familiar with this saying, this is it. So coming back on a slower, smaller time frame and more, to many people, what they'll call realistic numbers, we said the fourth time we come up to the 2000 level, and you mentioned this when you introduced me, will be the key break, and we'll support on the 2000 level. So this is known as a megaphone structure. It was a holding pattern. It's a continuation pattern, and we expected continuation, and that's the megaphone. So you had 1 meet, you had 2 meet, you had the third. We said on the fourth, you will support, wind up, and go. Now you were asking about any HVFs. Unfortunately, this one's already played out, but I'll show it to you just for interest because it highlights the asymmetric reward that this kind of trading gives. This is a volatility squeeze. Once you broke above the 2000, it wasn't long before you got slammed. And we said, this is a break, it's going to be awesome. And then everybody said, yeah, but look, it got slammed and it came back down. I said, that's part of the process. It's called a return move. You wind up and then you go. So first of all, you know, it's like a child. You say, you draw a line in the sand and say, don't put your foot on the other side of the line. And he goes like this with his foot, and then he pulls it back. It's exactly the same way. But then once he's got the confidence, he's no longer a child, he's big, and he breaks through and he runs and he knocks dad over. This is a volatility compression. So you could have bought in at this level with a super type stop at that level. And this is actually, ironically, you asked a question about HVF method. Not everybody does, but I actually have the risk reward for this. And the target is up at the first key point of rest, which we think will be on the doorstep of 2,900. Yes, you're having quite a pullback here, and I'll come to that now, where some people go, well, what's happening now? Remember, macro. Things don't go up in a straight line. You were actually 19. The lowest point there was 1984, and that was in February of this month. And you've already gone as high as 2,780. Even at 2,500, which it is not sold off to yet. You are $500+ up since February, which is not even a full year. We're not December. February was not the beginning of the year, but in safe to say around a 10-month time period, you have made 25% of your 2,000 if you've made $500. A solid 25, even at this current level, which is after a sustained period of sell-off. So some people might ask, why are we selling off? First of all, you don't go up on straight lines. You had a continuation pattern here as well. You could see it there. You had another one there. The markets move staccato, you know, a little bit left, a little bit right, winding up, and then they go again. The deeper you dip, the bigger the later reaction. You might make a beautiful winding up structure. So there's no such thing as bad price behavior. There's just bad trading positions. Now, in an investment sense, I'm the net long and I'm holding. In a trading sense, we had a head and shoulder over here on a lower time frame, which I'll show you. And we discussed this in our community. And we also called on YouTube, on our crypto channel, Bitcoin is going to start eating gold's headlines. In other words, gold is no longer going to be the fast mover and Bitcoin's going to happen. And this was before the election outcome. This was released about 3 weeks ago, and you can go and find it on the Crypto Sniper. So you can see you had just dropped down to the lower time frames. You could see you had some exhaustion. This is known as a head and shoulder. We do become familiar with reversal patterns. And we said, yeah, you got a small time frame one. This is what's going to happen. It's made its target and it's actually battered on. There was a rising wedge. We expect a little bit more and it's selling off. But at 2,500, I think you're going to find quite a lot more buying money to come in. And I would expect at some point soon there'll be a reaction. And then I would expect it to bounce. So for those that are late to the gold investment, this is personally, in my opinion, a pretty good investing time. For those that trade with leverage, you need stop losses and you need an HVF setup ideally, where you can have a tight setup that we've defined that is a volatility constriction. At this moment, the volatility is still high. We enter when it's gone super low and everyone's got bored again and it's not moving and everyone's a little bit tired. So yeah, that's the take on gold. I hope I've answered your questions there.
Yeah. Thanks for that. Maybe you can bring up the silver chart as well. Silver is more.
I'm going to slightly jump the gun. And before I bring up the silver chart and just make a key point that is very important for silver investors, because I'm also invested in silver, but not as much. And this is something we highlight in our newsletter. And I encourage people to, on our YouTube, go to the Market Sniper or the Crypto Sniper, grab our free course that will teach you a couple of things, 5-minute video each day for 5 days on the HVF trading. You will automatically be enlisted to our newsletter. It's entirely free. Anti-fiats are gold, and they are positioning crypto, the digital versions thereof. I don't trust it, but I will trade it as the alternatives. And the key thing is, in the beginning, gold, the king, moves first. Gold, the king, moves first, and you saw that. I will show you. In the crypto world, Bitcoin moves first, but he only gets up from the table after the king has got up from the table, which is gold. So the bigger set is the anti-fiat set, the one in the green, and a subset within that is the cryptos. And I will just show you how that the one follows the other. This is the gold. We did this on the 1st of November. It's now 2 weeks old. You can see how we were. This is a longer term gold chart. So Bitcoin is like a schizophrenic, fast-moving gold. It's a higher activity, higher beta, essentially. So that's a 5-day chart of Bitcoin. This is a 3-week chart of gold. It's important to mention Bitcoin also trades on the weekend. Of course, gold does not. So this was a continuation pattern after a bottoming. This is a continuation pattern after a bottoming. You had the run up to 2021. And then you had this megaphone structure that is a broadening structure for an extended period, which was just frustrating, and it's a continuation setup. You had the exact same thing. You had the Bitcoin ETF with BlackRock. You had the run up here. You had a megaphone structure downward. It's been a frustrating 6 months, not 3 years like it was for gold, for Bitcoin traders. And then it broke the megaphone. And just like it broke the megaphone there. Now, gold had already run and continued, and now Bitcoin is following, and it's eating a little bit of gold's feed, because it's now the digital gold, it's pro-Trump, it's a Trump trade item. So some of that money that might have been going into gold is also being deflected. Also, that US 10-year going up has seen the dollar index go up. And that's particularly hard on gold that's already been running for a while. That's the dollar. You've gone from almost 100 down here to 106.9. You're almost at 107. So the dollar has put in 7% across the euro, Swiss franc, British pound, Swedish krona, all the components of the dollar index since then. So that's quite a spit up in the dollar. So it's not surprising that gold's having a little bit of a pullback. Bigger market cap, into the headwinds of the strong dollar. Bitcoin's had a long rest for 6 months, just breaking out. The pro-crypto vibe, the possibility of a very, the SEC chairman being fired, who's been very anti-crypto and obstructive, open a lot of cases, being removed and someone more friendly put on, that has overwhelmed the dollar strength for crypto that's been resting for a while. So you've got a lot fitter a break out of Bitcoin at the moment. And there is that element that Bitcoin is now trotting a little quicker. There was its break, there was its pullback and return move, and since then it's been up and it's past 90,000. So there is that slight competitiveness. They usually, as a category, move well, but when one's tired and the other one's getting a little bit industry-specific support, like Bitcoin is, it can steal a little bit of the honey that's coming down for gold. So you were asking about silver, and I've managed to talk about a lot of things. Silver will follow gold, but later. And the problem we have is the gold-silver ratio is not breaking down. And technically, before I show you the silver chart, I'm doing the relative valuation. We need this basing ascending grind line that I've drawn there to break in this structure on the downside. And actually, I fear first that you might go higher here. And I'm warning people, this is all these things of CBDCs and UBI and all of this, this isn't happening next year. This is a decade and a half process that this sort of World Economic Forum agenda that's being pushed might unravel. You know, having everybody's property registered on the blockchain, all these goals that they have of knowing everybody's assets on this very easily examinable macro database. This is their big goal, where we all lose our privacy and can be surveilled, the surveillance finance agenda. That's not going to happen in a day. And I'm hoping there's going to be a lot of pushback personally, and that it doesn't get to happen at all. But the key thing is stay with gold. We talk in the Substack, it's like an engine that has a firing order in the cylinders. And I love diagrams because it helps. A lot of us are very visual. You've got to understand the firing order of the cylinders and stay there. It's a slow motion. Gold moves first. We've seen that. Then maybe Bitcoin is a time to overweight. Then you come back, silver will start to outperform on gold. But as long as that gold-silver ratio was on that chart as we were showing it, you need to stay mainly gold. So gold is the buy and the hold for now. There is a risk later that silver will be difficult to get. So that's why I have some, sure. But don't overweight silver too soon, because we need to see the real gain is when you break that basing ascending grind line and we break 75. When we fall from 75 and we start heading down to the 65, that's a very interesting time. We have a head and shoulder we're waiting to complete, and that will be a very, very awesome time to be in silver. And then you'll get outperformance. And actually, you're going to have some crazy performance in terms of profitability on the miners as well, because we're short oil. We're expecting the consumer, the direct consumer, is bringing down costs for mines, and you're going to get hyper profitability out of mines. So all these things will come, but don't be in them too soon. The commodity for the first, and hold for longer. You've got to do the timing right. Don't rush. Don't read the first 2 pages of chapter 1 and jump to chapter 2 and start reading the first 2 pages there. Read the full chapter, hold the line until phase 1 is over and we see the transition. In our community, we actively watch this to call these key triggering events, like the time, okay, it's good to be Bitcoin now, buy us a little bit for a spell. And we're waiting for that silver moment. It has not yet come. So I know that's not the news people want to hear, but this is a longer game. You're talking about economic case history that for 400, 500 years they'll be watching. They'll be thinking, what on earth were we thinking? So many economies, all globally synchronized to be hyper over indebted after a global workshop was sent to China and Thailand, and you got this low interest rate environment, and they thought, what the hell, we'll just drop the rate so low. They got so super over indebted. All these things happen. We go into a hyper stagflationary environment, ideal for gold. It will come, hold gold first and hold it long. And when we trigger, that's when you pivot to silver. And maximizing each of the stages is going to build you far more wealth than jumping to the end of the story and holding and watching everything else move around you while actually having suboptimal performance and realizing you're going to wait 15 years possibly on this. So play the game, play the steps. You don't take a lady out to dinner and jump straight in her lap. You know, you chat, you get to know each other, you have a wine, you share experiences before you lean in for that first kiss. And that would be how we should be playing this.
Okay. Thank you for this very good overview of gold and silver markets. And maybe for the end, what would be your final words for people who want to protect themselves against this fiat monetary system collapsing?
Yeah. So it's kind of like two bookmarkers we've had, 1980 to 2020, where the bond market, the traditional financial advisors, like all the books in between. And I'm saying you're falling off the shelf now. What worked for you in between the two bookends of 1980 with Volcker isn't going to work. It's a time for non-standard financial action. Your traditional financial advisor has written all the exams, is registered and all of that. They are trained in the period of the last 40 years. And I am anti them. I think what they will give you is destructive. You shouldn't be long in debt any instruments at all, not even to trade, because things could turn so terrible. You should actively have an aggressive gold position, which you should continue to build. And we feel Reset is going to incorporate so many more things than just the financial. There's going to be social repercussions. There's going to be a lot going on. There's going to be tax grabs of epic scales. You need to position yourself not only to build wealth, but to protect that wealth. And it's going to be non-standard of nature. It will be aggressively in precious metals, miners, and possibly even utilizing the new system they plan to invent, bring and implement, such as Bitcoin, to get those gains. But you will need to reposition for the stages as the firing order of the cylinder block is kicking through each stage. And I specialize specifically in looking to get that right. And we don't listen to what people say. We look and see what the market chart is doing. You know, the one thing that shocked me is that we were the only person for a full 2-3 years that called the end of the bond market. I'm saying, where are all the macro technical analysts? I don't even have to be a good one. It feels like I'm the only one. I watch a lot of YouTube. I watch a lot of financial things. Where was it? You know, everybody knows the dot-com market blew off in valuation and then it collapsed. Where were all? You're not paid to be calling the end of the debt system. They don't like that. And that's why. And you're only hearing Druckenmiller, Paul Tudor Jones now talking about shorting debts, etc., etc. They are late. Even if they're only talking the book after putting on the trade a year before, they're still late in terms of where we are. So we truly are macro technical. We look at the footprints in the sand, which is the chart itself. So grab the free newsletter in our YouTube. It's absolutely free to find out more about what HVF is. We are the market sniper, and the crypto sniper. Follow us, decide if you want to engage with us. If you do, we always have a link for booking a call and you can have a chat. We have a community, not on a Slack group, not in a WhatsApp, real private, high value people that recognize this is abnormal times. And most importantly, keep your spirits up. You're going to run an obstacle course. Everybody has to do this obstacle course, you know, unless you're jumping off a cliff. So we're going to run this obstacle. Get fit, enjoy it, and kill it. Because it's going to have to be run. The people that don't realize there's an obstacle course are going to absolutely struggle, and they're going to wonder why they're being dragged through the mud and having bullets shot over their heads and having to climb over this and that. They're going to give up. They're going to lose. They're going to fall by the wayside. You got to decide. You were chosen to live in these times. You can make it, and you can revel, be a leader in it, or you can pretend it doesn't exist and be an ostrich that puts your head in the sand and get kicked in the backside, or you can quit and be poor and be reliant on future government UBI. I've made my decision, and I'm surrounded by a community that have made their decision as well. And let me tell you, I'm embracing it and I'm loving my best life, and I live a good life and I'm grateful for it. And you can too, in spite of everything. Don't be psyoped into fear. Don't be psyoped into everything else. There is a real positive action that you can take to actually come out smiling. And it is a polarizing event for wealth. There will be those that took the right action and those that got crushed. And, I'm just very I'm not going to be passive about this in any way. Thank you for having me on.
Thank you. I will add the links below for everyone who want to see what you're doing and join these courses. Thank you very much for coming onto the show today, and see you next time, maybe in the future.
Absolutely.